This is Daria Shabad with CorporateProfile.com reporting on the news for Friday, July 13th, 2012. It is official. London's big whale, aka Bruni Iksil, has earned the JPMorgan's chief investment office a $5.8 billion trading loss. It also became evident that some JPMorgan traders tried to hide bad credit bets during the first quarter. This has been a very tough year for Jamie Dimon, and his reputation as the king of Wall Street is significantly damaged. But even with this loss, JPMorgan has still made a second quarter net income of $4.96 billion. Last year, JPMorgan's income was at $5.43 billion. In the attempt to put this little hiccup behind it, JPMorgan's chief investment office will no longer trade credit derivatives. New first quarter results will be published, and in the meantime, the company's shares rose by 36 cents in pre-market trading to $34.40. Come out, wherever you are, bad credit trades. I would not be surprised if the losses were to be adjusted to a higher number a couple of more times. New developments in the LIBOR scandal are rocking the media headlines. The Bank of England published emails from the year 2008 that seem to be undermining Deputy Governor Paul Tucker's recent claims at his parliamentary committee hearing that he was unaware of any LIBOR-related concerns. One of the emails, written by Tim Geithner, then head of the Federal Reserve Bank of New York and now the U.S. Treasury Secretary, on which Mr. Tucker was copied, was titled "Eliminate Incentive to Misreport." Yikes. Basically, the Fed knew about LIBOR inconsistencies and tried to encourage British regulators to bring more order to the flawed system. According to most media articles, Mr. Tucker was not available for comment. I wonder why. For him to say he had no idea whatsoever is scandalous. A dozen banks are currently being investigated in connection to the LIBOR rigging scandal, and we are all sitting on the edge of our seats waiting to find out who will go down next. So it is Friday the 13th, and I have taken it upon myself to investigate how this Western superstition, also known as Frigga Triska Decaphobia, came to life. There are several theories. First up, in numerology, the number 13 is considered to be an irregular number, whereas the number 12 is considered a number of completeness, as in the 12 months of the year, 12 hours of the clock, 12 gods of Olympus, 12 banks investigated in the LIBOR scandal. You get the idea. The day Friday has apparently been considered an unlucky day since the Canterbury Tales, but one author argues that the Friday 13th phobia came to life in 1907 when Thomas W. Lawson's popular novel called Friday the 13th was published. In this novel, and you can't make this stuff up, an unscrupulous broker takes advantage of the superstition to create a Wall Street panic on a Friday the 13th. So it all always comes down to our slightly flawed financial system and our totally messed up human nature. I'm Daria Shabad with CorporateProfile.com reporting directly from Wall Street. Thank you for watching, and please tune in again for more hot financial and world news.